Hi friends, hope you are fine. We are moving towards this second rule of investing and I'm pretty excited to share the rule with you because this rule can share hundreds and thousands and lakhs of dollars if you follow it carefully. So friends, the first rule that we had, I just want to reiterate, is that the first rule we studied is that the stock symbol, it's not an electronic blip or just a symbol. When you buy something, you are not buying a symbol. You are actually having an underlying ownership interest in an actual business which make product and goods and services and then delivers to the people, earns money just like any other business. So the point is that you don't have to invest without thinking or maybe considering it as a video game. It's not like that. Just think before you buy any stock. So consider reading its financial statements and do your homework before investing. That was rule number one. So are you making sure that you are not forgetting rule number one before investing, so that today we are moving one step ahead to the rule number two. So friends, I'm pretty excited. Let's begin this. So what is rule number two and who gave that? So these are the rules which are given by the legendary father of investing, Mr. Benjamin Graham, who was the guru of world's richest investor, Mr. Warren Buffett. So the second rule comes here on your screen. So the second rule says, friends, just one second. Yes, so the second rule says that the market is a pendulum that forever swings between unsustainable optimism, which make the stocks too expensive, and unjustified pessimism, which makes them too cheap. And the intelligent investor is someone who is a realist. He buys from pessimist and sells it to optimist. Now, I just want to elaborate on that. The point over here, Mr. Ben Graham want to make is that see, the market is actually a pendulum. So it moves from one side to another side. Sometimes it is very expensive, sometimes it is very cheap. So if you see the stock prices, then you will see that there are 52-week high and lows written on it. So that simply means that in the entire year, the stock has touched that much of high price and this much of low price. So it's like a pendulum. It's going from here to here, here to here. Now, most of the people, if you see, they will buy when the stock is rising and reaching to its height, and they sell it in the panic when the market is collapsing, the prices of the stock is going down, and that's how they lose money. Now, according to the rule number two, an intelligent investor, a smart investor, is actually somebody who is having complete peace of mind and deeper understanding of the business. So he just sits like a crane and waits for the right opportunity. Now, what is the right opportunity? If you follow the TV channels or maybe newspapers or something, according to them, the right opportunity is when the stock price is moving up. But in reality, for the investor, smart investor like you, the right opportunity is when the stock is going towards its 52-week low. It is nearing that, and the intelligent investor buys at the time everybody is selling, so he gets the best price, he gets the stock at a lower price. Now see, it's very simple, that if you go to the market, then would you like to overpay the price for some product? If you want to buy a television, then if the television costs say 30,000 rupees, would you love to pay 50,000 rupees for it or 10,000 rupees for it? Would you like to buy it for discount or to buy it for premium? Choice is yours. So if you are a smart investor, then always make sure that you buy when the stock is reaching towards its lifetime low or the 52-week low. So you buy at lower price. Remember the fact that the business behind that particular stock price is the same. It may be some, plus minus, some one quarter went bad or some profit is coming a little down or there is some news or something, but the business does not change. It remains the same. But the stock market's reaction towards events is making that business look like a loser, which actually is not. So the smart investor buys at the time everybody is selling, and then he sits with patience and let the people fool around and then make the stock again rise and become over expensive. Once the stock reaches over expensive limit, that is the time when the smart investor will sell the product, the stock, not buy the stock, right? So that is the second number of rule. And I hope that you understand that well now and you are smart enough so you can get the idea of this rule, right? So friends, I just want to again display rule number 1 and rule number 2 for your ready reference on the screen. I hope you will like that. So here we go. So friends, the rule number 2 says the market is a pendulum that forever swings between unsustainable pessimism and unjustifiable. Okay, so the rule number 2 says that a market is a pendulum that forever swings between unsustainable optimism. Everybody is happy. Everybody wants to buy this stock. Give me 10, give me 20, give me 30, give me 50. And the stock price goes just like a balloon. And sometimes when the market chips are down, market prices collapses, then there's unjustified pessimism. You might have seen that the stock prices crashing over more than 20% in a day. It happened, which makes them too cheap. And the intelligent investor, that's a realist who sells to optimists who are very happy, and he buys from the pessimist who are very sad and very negative, right? So that is rule number 2. And the rule number 1 for your reference was that again the stock is not just a ticker symbol, it or an electronic blip. It is an actual ownership interest in an actual business with an underlying value that does not depend on its stock price. So friends, stock price is not the first criteria to buy. The business interest and the business quality should be the first criteria to shortlist a stock, and then find the right opportunity when the stock price is low, then buy it. I'll tell you how to systematically, step by step approach to this particular theory. Right friends, so for this video, I think I just shared the basic idea. Please do work on that. Just get into any stock market website, find out this stocks which are good enough. Good enough means which are bigger companies, which are having less debt to equity ratio. Though this particular part I'll cover in different videos, but I just want to tell you that start looking at the businesses, start looking at the stocks, spend some 1 month's time understanding which stock is of what type, what business, what type of management, and what is going on in it, and just track the prices also, just to find out that whether the price is not overpriced or it is underpriced, right? So just start tracking, and I'll take you through the entire journey to make you a successful and happy investor. So happy investing. I'll see you soon in the next video where we'll talk about rule number 3 and then 4 and then 5. So friends, I hope you like this video. If you have not subscribed the channel, then please do it right now, and also press the bell icon. The reason is that I am giving you research-based actual investing deeper knowledge which will get you a lot of money in return in coming years. And just forward this video to most of the people on your Facebook, Telegram, WhatsApp groups, so that the actual research-based knowledge can save somebody from losing the money, and they will thank you from the bottom of their heart for that. So friends, see you soon in the next video. Stay tuned and do not miss that video. This is very important. Thank you. Take care. Bye-bye.